Welcome back to XRP Economic Radar, where we bring you the latest developments and critical insights from the world of XRP and the broader cryptocurrency market. Today we're diving into a fascinating story that has many in the XRP community buzzing with anticipation and speculation. We're looking at a massive movement of tokens off one of the world's largest cryptocurrency exchanges, and this is happening at a time when most people might least expect it. While XRP's price has been struggling and sitting near the $1 mark, something very interesting is happening behind the scenes. Large holders, the so-called whales of the crypto world, are pulling hundreds of millions of XRP tokens off exchanges in what appears to be a coordinated and sustained effort. This kind of activity often tells us a very different story than what we see on the surface, and it could have significant implications for where XRP is headed in the coming weeks and months. So stick around as we break down exactly what's happening, what the data is telling us, and what this could mean for XRP investors and the broader market. Let's jump right into the headline that's got everyone talking. XRP whales have pulled a staggering 500 million tokens off Binance amid a price dip that has seen the digital asset hovering around the $1 level. Now, to put this in perspective, we're not talking about small retail investors moving a few thousand tokens here and there. We're talking about massive withdrawals involving millions of tokens at a time, and this activity has been persistent and ongoing for several days now. What makes this particularly intriguing is the timing. Typically, when prices are falling and sentiment turns negative, we see the opposite behavior. Investors often panic and rush to move their assets onto exchanges to sell them. But here, we're seeing the exact reverse. Large holders are taking their XRP off exchanges and moving them into private wallets or cold storage. This creates a notable divergence between price action and whale behavior, and many market observers believe this could eventually lead to what's known as a supply squeeze, where the lack of available tokens on exchanges drives prices higher when demand returns. To really understand what's going on, we need to look at the data, and that's where community figures and analysts have been doing some excellent detective work. A prominent XRP community member known as Zaif has been tracking these movements closely using data from CryptoQuant, which is one of the most respected blockchain analytics platforms in the industry. According to Zaif, daily XRP outflows of more than 1 million tokens have accelerated significantly, and this is happening even as the coin has fallen over 20% since May. Think about that for a moment. The price is dropping, sentiment appears bearish, and yet someone or multiple entities are consistently absorbing every dip. Zaif wrote on social media that these persistent large withdrawals occurring while prices remain under pressure tell us that sophisticated investors are viewing these lower prices as buying opportunities rather than reasons to panic. This is classic accumulation behavior, where smart money quietly builds positions while the broader market is focused on short-term price movements and negative headlines. In a separate update that adds even more context to this story, Zaif noted that roughly 89 million XRP was withdrawn from Binance in just a single day. Let that sink in for a second. 89 million tokens moved off the exchange in one 24-hour period. That's an enormous amount of value being relocated, and it represents a significant shift in where these tokens are being held. But there's another piece to this puzzle that makes the situation even more interesting. At the same time these massive withdrawals were happening, XRP funding rates dropped to negative 0.012, which is one of the most bearish readings we've seen in recent months. For those who might not be familiar with funding rates, they're essentially the cost of holding a leveraged position in the futures market. When funding rates are negative, it means that short sellers, the traders betting on price declines, are actually paying long traders, those betting on price increases, to keep their positions open. This typically reflects an expectation of lower prices ahead, and it shows us that many derivatives traders are positioning for further downside in the near term. Now let's talk about what's happening specifically on Binance, which is one of the largest and most liquid cryptocurrency exchanges in the world. Crypto commentator Diana, who also relies on CryptoQuant data for her analysis, has made some observations that align perfectly with what Zaif has been reporting. According to Diana, XRP supply on Binance keeps disappearing, and this is occurring while traders are placing their largest bearish bets in months through the futures markets. The hard numbers here are quite striking. Binance's XRP reserves fell from approximately 2.766 billion tokens on May 24th to about 2.691 billion today. That's a decline of 75 million tokens in a relatively short period. When you combine this steady decrease in exchange reserves with the fact that funding rates remain negative, you get a picture of a market where the derivatives traders are betting one way, expecting prices to fall, while the spot market whales are doing something entirely different, accumulating and removing supply from exchanges. This kind of divergence between different segments of the market often precedes significant price movements, though the direction isn't always immediately clear. The pattern of withdrawals we're seeing isn't just a 1 or 2 day phenomenon either. This has been going on for an extended period, and the numbers are truly significant when you zoom out and look at the bigger picture. The latest observations we've been discussing align perfectly with a detailed report from crypto quant analyst Amr Taha, who has been specifically tracking large outflows from Binance. According to Taha's research, Binance recorded around 465 million XRP in large daily outflows between June 3rd and June 11th. That's essentially a 9-day window where nearly 500 million tokens left the exchange. To put this into even sharper focus, Taha found that transactions involving more than 1 million XRP have become increasingly frequent since the start of June. These aren't small trades or regular user withdrawals. These are whale-sized movements, the kind of activity that suggests institutional players or very high net worth individuals are actively building positions. The repeated nature of these withdrawals is particularly telling because it suggests this is a sustained strategy rather than a one-time event or a single entity moving funds around. It's important to clarify what this data actually means and what conclusions we can reasonably draw from it. Amr Taha emphasized that this trend is not the result of a single large transfer, which could potentially be explained by something like an exchange moving tokens to cold storage or a single whale redistributing their holdings. Instead, what we're seeing reflects a series of sizable withdrawals spread across multiple days and likely involving multiple different entities. This distribution of activity across time and participants makes the pattern much more significant from an analytical standpoint. It suggests that there's a broader sentiment among large holders that now is the time to move tokens off exchanges, despite the challenging price environment. When you see this kind of coordinated behavior, even if it's not explicitly coordinated but rather multiple parties independently reaching the same conclusion, it often signals that something is shifting beneath the surface. The big money is making moves that aren't immediately obvious to casual observers who are only watching the daily price charts. Now, before we get too carried away with bullish interpretations, it's crucial to maintain a balanced perspective and understand what these exchange withdrawals do and don't tell us. Large exchange withdrawals do not automatically confirm accumulation in every case. There are other reasons why tokens might leave an exchange, including regulatory concerns, security considerations, or simply portfolio reorganization. However, what these withdrawals definitely do accomplish is reducing the amount of XRP that's readily available on exchange order books. When tokens are sitting on an exchange, they can be sold at a moment's notice with just a few clicks. But when they're moved to private wallets or cold storage, there's friction involved in bringing them back to market. The owner has to go through the process of transferring them back to an exchange, which takes time and creates a barrier to impulsive selling. In effect, this reduces the immediate selling pressure on the market because there are simply fewer tokens available for traders to sell quickly. This is why exchange reserves are watched so closely by analysts. They represent the liquid supply that can impact prices in the short term. Let's dive deeper into the technical side of things and talk about why funding rates matter so much in understanding the complete picture of what's happening with XRP right now. As we mentioned earlier, negative funding rates typically mean that short sellers are paying long traders to keep their bearish positions open. This payment structure exists because the market is imbalanced, with more traders wanting to bet against the price than betting for it. In normal circumstances, this reflects expectations of lower prices ahead, and it's generally considered a bearish signal. The more negative the funding rate becomes, the more expensive it is to maintain those short positions. But traders are willing to pay that cost because they believe the price will decline enough to make their trades profitable. However, there's a flip side to extremely negative funding that doesn't get talked about as much in mainstream coverage, but that experienced traders understand very well. When funding rates become excessively negative, it actually increases the risk of what's called a short squeeze, and this is where things can get very interesting very quickly. Here's how a short squeeze works and why it's relevant to the current XRP situation. If XRP unexpectedly moves higher, perhaps triggered by positive news, a change in market sentiment, or simply the supply shortage we've been discussing, short sellers find themselves in a painful position. Their bets are losing money with every uptick in price, and eventually they face a choice. They can either hold on and hope the price comes back down, continuing to pay the negative funding rate and watching their unrealized losses grow, or they can close their positions by buying back the XRP they sold short. The problem is, when many short sellers try to close their positions at the same time, they all need to buy, and that buying activity itself pushes the price even higher. This creates a feedback loop where rising prices force more shorts to close, which causes more buying, which pushes prices even higher, and so on. As Zaif eloquently puts it, every short is future buy pressure. Those bearish bets sitting in the futures market represent potential buying that will need to happen at some point, either when traders close losing positions or when they eventually take profits on winning ones. So what's the current state of XRP's price, and how does it fit into everything we've been discussing? According to the latest data from CoinMarketCap, XRP is trading at $1.14. The token is up 0.22% over the past 24 hours, which shows relatively stable price action in the very short term. Looking at the weekly time frame, XRP is actually up 4% over the last 7 days, which suggests some recovery momentum may be building. However, when we zoom out to longer time frames, the picture becomes more challenging. The token remains down roughly 20% over the past month, which confirms the price weakness that has accompanied these large withdrawals we've been analyzing. Even more significantly, XRP is down about 38% since the start of the year, which has understandably created frustration among some holders and led to the bearish sentiment we're seeing reflected in those negative funding rates. This price context is crucial because it shows us that the whales making these massive withdrawals are doing so in a genuinely difficult environment, not during a euphoric rally where everyone wants to buy. The combination of all these factors creates a really fascinating setup that could play out in several different ways. On one hand, you have significant bearish positioning in the derivatives market, with traders paying to maintain short positions because they expect lower prices. This represents real conviction that XRP has further to fall, and these traders might be right. Markets can stay irrational longer than many people expect, and price declines can continue well beyond what seems reasonable. On the other hand, you have this persistent withdrawal pattern that's removing hundreds of millions of tokens from the readily available supply on exchanges. This is happening across multiple days, involves numerous large transactions, and continues even as prices fall, which suggests accumulation by entities that have a longer time horizon than derivatives traders. When you combine decreasing exchange supply with the potential for a short squeeze if prices move higher, you create the conditions for significant volatility. The market is essentially coiled like a spring, with pressure building on both sides. What makes this situation particularly intriguing for those of us who follow XRP closely is the historical precedent for this kind of setup. We've seen similar patterns in the cryptocurrency market before, where exchange reserves decline during price weakness, funding rates become extremely negative, and then a sudden shift in sentiment triggers rapid price appreciation. Bitcoin went through this exact cycle multiple times during the 2022 bear market, where each local bottom was accompanied by negative funding and declining exchange reserves, followed by sharp relief rallies that caught short sellers off guard. Of course, history doesn't repeat exactly, and XRP has its own unique factors, including ongoing regulatory developments, the broader adoption of Ripple's payment technology, and its specific community dynamics. But the underlying market mechanics of supply and demand are universal across assets. When supply becomes constrained and shorts are overextended, the conditions exist for explosive moves. Whether those conditions will be triggered in XRP's case remains to be seen, but the setup is certainly there. For investors trying to make sense of all this information, the key is to look beyond just the daily price movements and understand the deeper currents moving through the market. The surface-level story is that XRP has been weak, falling 20% in a month and struggling to hold the $1 level. That's what most people see, and that's what drives the negative sentiment and the bearish futures positioning. But underneath that surface, there's a different story being told by the whale activity and the exchange reserve data. Large, sophisticated holders appear to be using this weakness as an opportunity to accumulate, moving tokens into private storage where they can hold for the longer term without being shaken out by short-term volatility. This is the classic pattern of how major bottoms form in markets. The smart money quietly accumulates while the crowd is fearful and focused on negative price action. Then, when sentiment eventually shifts, there's a shortage of supply available to meet new demand, and prices adjust rapidly. None of this is guaranteed, of course, and markets always carry risk, but understanding these dynamics gives you a more complete picture than just watching the price chart alone. Looking at the broader implications, What's happening with XRP right now also tells us something about the maturity and sophistication of the cryptocurrency market as a whole. We're seeing complex dynamics playing out across spot markets, derivatives markets, and on-chain activity that require multiple data sources and analytical frameworks to fully understand. The fact that we have tools like CryptoQuant providing transparent blockchain data, community analysts like Zaif and professionals like Amr Taha interpreting that data, and platforms where this information can be shared and discussed represents a massive evolution from the early days of cryptocurrency. Investors today have access to institutional-grade analytics that simply didn't exist a few years ago, and this transparency allows for much more informed decision-making. Of course, having more data doesn't automatically lead to better decisions, and there's always the risk of analysis paralysis or seeing patterns that aren't really there. But the overall trend toward greater transparency and more sophisticated analysis is undoubtedly positive for the market's long-term development and for participants who take the time to understand what they're looking at. As we wrap up today's deep dive into this developing story, the key takeaways are clear. XRP whales have withdrawn approximately 500 million tokens from Binance over a concentrated period, and this activity has continued and even accelerated despite prices falling 20% from their recent highs. At the same time, derivatives traders have positioned heavily for further downside, with funding rates hitting some of the most negative levels in months. This creates a divergence where spot market whales appear to be accumulating, while futures traders remain bearish. Binance reserves have steadily declined from over 2.7 billion tokens to under 2.7 billion, representing a meaningful reduction in readily available supply. The pattern of withdrawals shows multiple large transactions spread across many days rather than a single event, suggesting broad-based whale activity. And all of this is happening while XRP trades at $1.14, up modestly in the short term but significantly down over monthly and yearly timeframes. Whether this setup resolves with a continuation of the downtrend or with a sharp squeeze higher remains to be seen, but there's no question that something significant is happening beneath the surface. That's all we have for you today here on XRP Economic Radar. If you found this analysis valuable and you want to stay updated on all the latest developments in the XRP ecosystem, make sure you subscribe to this channel so you never miss an important update. Hit that like button if you appreciated the detailed breakdown we provided today, and please share this video with anyone you know who's interested in XRP or cryptocurrency markets in general. The more people who understand these deeper market dynamics, the better informed our community becomes as a whole. And don't forget to drop a comment below letting us know what you think about these massive whale withdrawals. Do you believe this is accumulation that will lead to higher prices? Or do you think there's another explanation for what we're seeing? We love hearing different perspectives and fostering intelligent discussion in the comments section. Thanks so much for watching XRP Economic Radar, and we'll see you in the next update with more critical insights and analysis you need to navigate these markets successfully.